Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting for us this morning is Pure Hydrogen Corporation Limited Managing Director Scott Brown, who will provide an update on the proposed spin-out of Pure Hydrogen's Australian gas assets into a new ASX-listed gas exploration and development company, Eastern Gas Limited. Scott is also joined by Eastern Gas Limited Managing Director David Spring, who will delve into the two highly prospective tenements in Queensland's prolific Cooper Basin and Walloon CSG Fairway, that being the Windera Gas Project and Project Venus. Now, David has over 35 years' experience as an executive and geoscientist, and most pertinently, he previously held the role of Executive General Manager of Exploration at Senex Energy, so is immensely experienced in this part of the world. Questions can be submitted either through the questions section on Zoom or by emailing me at alex@investorstream.com.au. We will attempt to get through as many questions as time permits. You can access the presentation from the ASX, and a copy of the webinar will also be available on Pure Hydrogen's website and social media platforms later today. Now, many investors have already taken the opportunity to send in questions regarding the distribution of shares, and we have included those in an FAQ which can be found on slide 21. But for now, I'd like to throw it over to Scott to kick things off for us. Scott, the floor is yours.
Okay, great. Thanks very much, Alex. Look, we're quite excited about spinning out our Australian gas assets. We think it's a very good beneficial for our shareholders, and we think it's also a great investment opportunity for the new company, Eastern Gas. If you could go to the next slide. So we've got a short disclaimer. Next slide. So at the moment, we've got a portfolio in Pure Hydrogen that consists of zero-emission vehicles. We've announced a number of things related to both our hydrogen fuel cell vehicles and battery electric vehicles. We've got a very much a commercial suite for, large trucks like the one behind me, a prime mover, and also garbage trucks, rigid trucks, and also buses. So we think we've got an extremely competitive situation in regards to vehicles. And the other side of it is looking at selling hydrogen equipment or making hydrogen equipment available to potential customers, so that not only can they get the vehicles, they can also have all the refueling that they would possibly need to run their fleets. And finally, we're building a micro hub in Archerfield in Brisbane, and we see that as a really good demonstration plant that will be able to show and showcase our technology. At the moment, we do have these gas assets. We've spent a considerable amount of money on them. We've got a really good gas resource, but it really doesn't fit with what we're trying to achieve, and hence that's why we're looking to spin out these assets and have them run in a separate company with a separate board and a separate management, so that they can reach their full potential. So hence that's why we're looking to spin this out. So next slide, please. So for shareholders, what does it mean? Well, effectively for Pure Hydrogen shareholders, you will receive free shares in Eastern Gas. It'll be via a in-species distribution, depending on your current shareholding. And that will be for every 5 shares that you hold in Pure, you'll get 1 new share in Eastern Gas. We expect that we'll raise between $8 and $10 million in the IPO. Look, following the IPO, Eastern Gas shares will be separately listed on the, subject to ASX approval or on the ASX, and you'll be able to deal with your shares as you see fit. Just a couple of things. You don't have to do anything to receive the in-species distribution. This will happen automatically by the share registry. We're looking forward to moving this forward. So I might hand over now to David to talk about the individual assets and what Eastern Gas has in store.
Great, thank you very much, Scott. Much appreciated, and very pleased to be here, and very pleased to be talking with you all, and look forward to getting some of your questions answered later on as well. So if we go to the, I guess it's my first slide, please, Alex. So today we'll briefly introduce the company and our strategy. We'll discuss our assets in some detail and our commercialisation path before finishing with an overview of the East Coast gas market. Yes, thanks. On completion of the IPO transfer agreement with Pure Hydrogen, Eastern Gas will be 100% owner and operator of two high-quality gas assets in Queensland. Both are located in premier East Coast Australian sedimentary basins, close to gas infrastructure with numerous commercialisation options. They have combined 2C contingent resources of 453 BCF with significant prospective resource as well. And we have a clearly defined work program upon IPO funding in order to move resources from the contingent category to prove reserves for future production. And our board has experience in all facets of the industry. Thanks, Alex. Eastern Gas was incorporated in 2024 to realise the potential of proven gas assets that are located close to infrastructure during a period of strong gas demand, recognising that gas is key to the energy transition and that many critical industries rely solely on gas for energy supply, and in a market of stronger for longer gas prices, having been greater than or around about $10 a gigajoule for the last 5 or 6 years, with forecast prices in excess of 12 gigajoules in the short to long term. Or $12 a gigajoule, I should say. Next, thanks, Alex. So briefly, the gas assets are, firstly, ATP 927, which is located in the west of Queensland in the prolific Cooper Basin, and it's adjacent to the Moomba gas infrastructure, with 330 BCF of 2C contingent resources and 4.4 TCF of prospective resources, so a substantial resource base. ATP 251 is located on the other side, in the southeast of Queensland, in Australia's premier coal seam gas fairway in the Surat Basin, with 123 BCF of 2C contingent resources. Both are in geographically favourable locations, adjacent to producing fields, adjacent to infrastructure with domestic and export gas transmission, and are advantageous for additional commercialisation options. Thank you, Alex. Now let's briefly describe or discuss both assets with a little bit of detail, and we'll start with ATP 927. It's a 480 square kilometre block located in the northeast section of the Cooper Basin, where there are adjacent producing fields and infrastructure tying into the Moomba plant. So those producing fields I just mentioned are those big red blobs you see on the map. For example, Mount Howard, which is located just south of 927, Wanto, which is just to the southwest. And those red lines are the pipeline infrastructure taking gas from those fields into the Moomba network, which is just on the southwest of that map. The principal play in the block is a Permian-age basin-centred gas, which I'll discuss in the next slide. Four wells have been drilled in the block to date. They are Queenscliff 1, which is kind of central south of the block, and Tamarama 1, 2, and 3, which are located in the southeast of the block. These wells were drilled between 2014 and 2018. As previously noted, there are substantial 2C contingent and prospective resources in the block, and the planned activities are a fracture stimulation program in Queenscliff 1 in order to achieve commercial flow rates, which in turn will result in proven 2P reserves in order to commence pilot production. Thank you. The key so we'll talk a little bit about the stratigraphy here, and then I'll talk about the basic set of gas, what it is, and how it relates to 927. So the key stratigraphic targets are tight fluvial channel sands, Permian age, Patchwara, Talachi, and to some extent the Triassic Arabri formations, which are encased by mature coal or carbonaceous source rocks. And they're highlighted on the right-hand side of your screen on the lithostratigraphic chart. Defining a basin set of gas play, it's an unconventional system with regionally pervasive accumulations, and that's really critical, regionally pervasive accumulations that are gas saturated, abnormally pressured, and commonly lack a down-dip water contact and have a low permeability reservoirs. So how does it look in this particular area regionally? So from the Permian point of view, the Permian is absent through erosion and onlap in the northwest of the area, and then reaches a maximum thickness of 180 metres in ATP 927. And these are highlighted on the map in the centre of this slide by the black contour, or contours, I should say. So they'll go from north to 150 from the northwest to the centre of the block. The eastern limit of this play in this area is defined by the vitrinite reflectance of 1.35%, or it's a thermal maturity indicator. And the updip limit for the play is indicated on the map by that dashed line, which goes north to south over the eastern side of the map. So the play itself is defined as existing over to the west of that east of that particular line. In addition, if we look at the colour fill maps, that illustrates the structural configuration at the time of peak hydrocarbon generation and expulsion. So the purple there being the deepest the basin was at the time the source rocks reached their peak hydrocarbon generation and expulsion. And as you can see, puts ATP 97 right in the centre of that area, so it is not only the thickest, but it's also the most thermally mature Permian section for the play. Interestingly enough, to the south and east of this area, at lower maturity levels, there occur a number of wells with known free water-bearing Permian sandstones, so that clearly demonstrates are outside of the area of the particular play. Also, the nearby fields, all those red blobs that we looked in the previous slide, they are all structural closures, while the wells, those four wells that I mentioned, drilled in ATP 927, establish movable gas at locations independent of structural closure, therefore proving the basin centre gas principle in play. Next, thank you. In 2019, Real Energy was granted a pipeline licence, PPL 2041, connecting the Tamarama well area to the Santos-operated Mount Howard facility to allow throughput of Windora gas to the member facility. So you can see that as a dashed line on the map, just heading from the southern or southeastern portion of the block just to the south to Mount Howard. Following this, a tie-in and processing agreement was signed with Santos in 2019. So being 5 years ago, discussions will be reinitiated with Santos following the IPO in anticipation of successful operations on the block. In addition, an HOI with Turquoise Group provides for an alternative commercial path with the potential for installation of a natural gas to hydrogen processing facility based on the plasma arc technology. Thank you. So the second of the block is ATP 2051, and as previously mentioned, it's located in the world-class Walloon coal seam gas fairway in the Spinout Basin in southeast Queensland. It has 2 contingent resources of 130 petajoules and 2U prospective of 536 petajoules, or half TCF if you like, of gas resources. The Walloon fairway itself has over 10,000 wells drilled to date, and they are indicated on this map by all those green dots located down the southeast and northwest of our block, which is in the centre of the map there. Has proven reserves of tens of TCF of gas and production in the order of 4 petajoules a day. So all very substantial and significant. And there's also a very complex distribution of pipelines and processing plants located adjacent to ATP 2051. Also, really importantly and interestingly, in the last 4 to 5 years, there has been significant merger and acquisition activity in the area, with deals valuing proven reserves between $1 to $2 a gigajoule. And with the activity that's going on in the area, it's also brought about other companies who have bought the assets, increased production for the region as well, which is very important when you look in a moment at the gas market. The final point on this is that ATP 2051 is not subject to Australian market supply condition. Next one, please. So briefly, just on the stratigraphy, the Walloon coal measures are a series of interbedded coal seams, shale, silt and sandstone beds of Middle Jurassic age in the Spinout Basin. It comprises 3 distinct coal measures called the Upper Juanda, Lower Juanda and Taroom coals. And you can see those packages highlighted on the right-hand side of the screen in the stratigraphic column. Although they are all different throughout the Spinout Basin, the entire Walloon coal measure has a potential to produce commercial quantities of petroleum, although the highly prospective CSG fairway is commonly depth and structurally controlled. So we're talking about a very thick interval of, let's say, a couple of 100 metres, of which right through that entire basin has potential for commercial production. Next slide, please. There have been 5 vertical CSG wells drilled to date in ATP 2051. They are located in the northeast, and then a few others just in the south and to the west of where we're pointing at the moment. Yeah, around there, that's right. Yeah, the 5 wells. And the last was the Real Energy well, Venus 1, which was drilled in 2021 and flowed an initial gas breakout of 84,000 cubic feet per day. So very encouraging. And what was also encouraging is that all the wells encountered Walloon coal measure coals with characteristics in line with those along the drilled fairway, although permeabilities are impacted by depth, which in the area ranges from 400 to 800 metres from east to west across the block. And the map that you see there is a depth of the top Walloons, demonstrating that variation in depth from east to west. But based on the well control, the net coal increases to the west and decreases to the south and decreases to the east as well. So although we're getting a little bit deeper, we're getting thicker coal sections, thicker net coal sections. Within ATP 2051, the wells that have been drilled would indicate that the Upper Joanna McAllister seam is currently considered the most prospective for commercially viable hydrocarbons in the block based on minimum permeability cutoffs. And analysis of flow test data and modelling indicates commercial gas rates can be achieved within those the Upper Joanna coals with a more aggressive stimulation method, or we believe our horizontal well. So to that extent, our planned activity post-RPO is to drill and flow test 2 horizontal wells targeting the Upper Joanna coals with the aim of achieving commercial flow rates and converting contingent resources to reserves for near-term production. Okay, next slide, thank you. So just moving on just to the final section, which is the gas market conditions, and I'll just briefly touch on those. Today, it's widely accepted by industry, government, and policy bodies that gas has a critical element to play in the energy transition and in providing Australia with energy security. This clearly plays to our benefit in the near term, medium term with the assets we have. Next slide, please. So our final 2 slides are just summary of results of the November 2024 ACCC analysis of the gas market, with the first slide here illustrating that over the last 5 to 6 years, East Coast netback prices have been steadily around $10 per gigajoule, with huge spikes during those tumultuous times in 2022 and 2023, with forecast prices between $12 and $15 a gigajoule for the near to medium term. And to the next slide. While simultaneously, the market is forecasting to have a shortfall in supply to the East Coast, potentially commencing as early as 2027, growing rapidly to 45 petajoules a year within 12 months and up to 500 petajoules a year in 5 years. So significant shortfalls in the near term. So the combination of forecast supply imbalance and high price are advantageous for new commercial discoveries and production. And just the final slide here, a photo of the board, and we'd like to thank you for your time today and listening to this presentation and then the questions that will come up. And I personally, and we all really look forward to having a positive result in the IPO and the subsequent commercial results in our operations in both blocks. So thank you very much.
Thanks very much, David. As he mentioned, we do have, as you can see here, a slide on the frequently asked questions. I would like you to just draw your attention to that slide. We have had a lot of questions around the distribution of shares. Hopefully your questions are answered there. Now, we do have some questions that have been submitted as well by investors. And David, I'd like to start with you if I can. On the regulatory side, the market has been subject to exploration restrictions in the large eastern states, being New South Wales and Victoria. In your view, how easy is it to get new gas exploration permits in Queensland compared to other states?
If we take the country as a whole, most certainly Queensland is infinitely better than the states you mentioned first off, Victoria and New South Wales, who are not doing much in this space at all. Western Australia and South Australia have generally been probably the leaders in this, closely followed by Queensland. As we go forward, I think the government, and certainly with my expectation of the new government, is that there'll be an increasing number or frequency of bid rounds in the coming years due primarily to the shortage that I just spoke about in supply. There has been limited activity in recent years as some new regulations have been trying to be put in place with respect to environmental restrictions, but we don't see those as having an impact going forward. So I think we'll see Queensland be a little bit more aggressive in the next few years, and certainly up there with what we've seen in South Australia and WA in recent years.
Thanks, David. Now, Scott, if I could just get you on camera for a second. Now, following the IPO, will PH2 transfer its investment stake in Batala Holdings into the Eastern Gas entity?
Thanks, Alex, for the question. Just before I answer that, another comment just about the previous question. Pretty much it's mission impossible to get new licenses in New South Wales or Victoria. And Queensland, even though the government will try and do things, I think it'll take some time before they have new licenses. Now, coming to your question about Batala, Batala is a asset. We own some shares in that company. They're focused on Botswana and coal seam gas play there. Look, I think it's a very different proposition than East Coast gas situation, and therefore, we didn't think it appropriate to put those assets into Eastern Gas, which is more about the East Coast assets, and we think that they're better suited to be in their own entity, and that's why we've done it that way.
Thanks, Scott. Now, David, you mentioned the favourable market environment for East Coast gas prices in recent years. Can you just elaborate on the dynamics that are expected to support prices over the long term?
I see them pretty much a continuation of the forces that are in play today, principally that there's strong domestic and international demand, and I don't see that, and certainly there are no forecasts for that to drop off in the forthcoming years. So I see that's going to remain in place. I think that because there has been a lack of or drop in activity in recent years, that's produced a shortfall in production in the market. So I feel that they'll continue. Those two issues in particular will continue, and will require significant new projects and production if it's going to change those. So I just don't see in the foreseeable future a huge change in the dynamics that are driving the current market situation.
Thanks, David. Now back to you, Scott. Pure Hydrogen has held its Australian gas assets for a number of years now, alongside its strategy to spearhead the growth of zero-emission vehicles. What's the strategic rationale for splitting out the gas assets into a separate entity at this juncture?
That's a good question. Look, our main focus is really on hydrogen fuel cell and battery electric vehicles, together with all the associated infrastructure. And it's very much a case of we have a limited amount of ability to fund activities, and so hence we think it more appropriate that Eastern Gas be spun off and have a separate board and management and a separate funding for that activity, which is quite different to the other.
Sorry, Scott. We just lost your audio there. Now, David, how do you see infrastructure developing over the coming years to support the supply of gas to East Coast gas markets? And does Queensland have the potential to become an exporter of gas to major centres in New South Wales and Victoria?
I think the infrastructure side of things will see sort of incremental adds to the current network, as it's certainly in the case of the coal seam gas play. There are large areas of that play which are really untested or undrilled at the moment, including 2051 really. So the infrastructure will just continue to grow as a nest, and into the main pipelines, into the major plants. I think we'll get an increase in infrastructure up into Townsville to address some of their requirements for the industrial areas up in the port there. Whether they can actually supply more to New South Wales and Victoria is quite problematic, I feel. I think the demand, certainly with the LNG plants and just the domestic and industrial up in Queensland, something significant would have to happen to the supply to be able to then turn around and supply and put more into into New South Wales and Victoria. And maybe you got some thoughts on that, Scott, but I'm just not seeing it being possible for Queensland to be a huge supplier down south going forward.
I think there'll be enough demand just locally and with the exporters to any molecules we produce would be snapped up, I think, pretty easily. So
I agree with that. Yep.
Yeah.
Thanks, David. Now, Scott, your role as managing director of Pure Hydrogen puts you heavily involved with emerging hydrogen technologies. Do you think gas can play a role in the development of the hydrogen economy by acting as a bridge fuel for hydrogen production?
Absolutely. There's two things. Obviously, I think it will play a role in transitioning towards renewables, firstly, and then secondly, in the hydrogen economy, we do see it playing a role. And that's one of the reasons we've actually invested in a company called Turquoise Group, which we own 40% of. They've come up with technology to essentially take natural gas and then split it in its component parts, being the hydrogen component and also then a solid carbon component. And they can do that without a lot of water and without any emissions of CO or CH, carbon dioxide as well. They're currently got a demonstration plant at Darra, which is running a number of trials quite successfully, producing graphene and which is a very highly valued commodity as well as hydrogen. So we see natural gas absolutely playing a role, and we do think there will be links between Turquoise and Eastern Gas in the future as the company builds out reserves and production and so on. So we do see it playing a pivotal role in hydrogen transition.
Thanks, Scott. Now, your audio just dropped out.
Can I just make a comment on that there? Just from my point of view on Eastern Gas, it gives us another avenue for commercialisation. That's not a huge offtake of gas, but it's substantial enough for sure, and it means that we don't have to, in a success case, put interconnectors into all pipelines for all of our gas. So we can actually have smaller on-site facilities which provide for that hydrogen market.
Thanks, David. Now, Scott, we just lost your audio a bit earlier. I just wanted to re-ask the question if I can. What was the strategic rationale for splitting out the gas assets into a separate entity at this juncture?
Look, our main focus has been on the pure hydrogen businesses, particularly, in relation to hydrogen vehicles, both fuel cell and battery electric zero emission vehicles. So that has been very much our focus. In addition, we've lined up a number of solutions to be able to refuel those vehicles and supply fuel to those vehicles. So that's really our main focus. Consequently, we just think if the gas assets remain within Pure, they wouldn't be funded to the extent they needed to be to get them into commercialisation. And we think this is the best structure to give investors, in the best interest of investors, to pursue this structure that we're currently pursuing, spinning out the assets into a new company, Eastern Gas.
Thanks, Scott. Now, just going back to, I guess, emerging hydrogen technologies, I'm not sure if you're aware of this, but the USGS recently announced that they believe there are large naturally occurring hydrogen deposits in the ground similar to methane, and revealed a map of US deposits. Are you aware of these developments, and what are your initial thoughts?
Yeah, look, we've been aware of natural hydrogen for a while, and there are some listed companies pursuing that in Australia. Look, we wish them the best of luck. The problem is hydrogen often will come with other components, other gases, and hydrogen in its raw state will generally mix with those other gases and other elements that it comes into contact with. So there's two things to say about it. Firstly, it is then quite costly to transport the hydrogen from where it may locate to where the customer actually needs the hydrogen. And so transportation costs are often a really big factor. And if it's way out in the boondocks, then it's difficult to necessarily transport it and make the economics work. So that's number one. And the other thing is, if it occurs with a lot of other gases, then you've got to separate them out to get the hydrogen. So certainly we're open to it, and it's something that we'll look at, and we're happy to talk to companies that do have hydrogen natural occurrence, but we're not actively sort of pursuing it, if you like, from an exploration point of view.
Thanks, Scott. Now, we just had a question about, I guess, the rationale for the IPO price point being at 20 cents per share. Can you just talk us through the rationale for coming up with that figure?
Sure. So this is very much driven by listing rules of the ASX. So pursuant to that, the ASX requires us to have a listing price of 20 cents as a minimum, and that's what we've done. The other thing about valuation, we've spent, both, Pure and the predecessor companies spent in the order of about 45 million on these assets over the last several years, and hence we're looking to effectively spin it off at a valuation around pre-money of around $16 million. So we think that's a fairly significant discount given the amount of work and time and effort that has gone into getting the assets to a resource status. To move it from this to into reserves, we think over the next few years that's certainly possible, and that's the rationale for raising between $8 and $10 million.
Thanks, Scott. And just, David, to finish off, with the capital raised from the planned IPO, can you provide us with a summary of the key operational milestones that Eastern Gas wants to achieve over the next 6 months, and the key near-term milestones as well?
We'll take the 6 month one, I guess, first there. I don't know if near term is longer than that or shorter than that, but if we step back just a little bit, over the last few years, Pura has done quite a bit of modeling and planning for activities in both blocks. And we spoke about, let's say, take for example, the first one in ATP 927, where there's a fracture stimulation on Queenscliff 1. So considerably thought has gone into that and planning has gone into that. So over the next 6 months, what I would expect there is we actually fine-tune that more, because there's been quite a number of, I guess, fracture stimulation programs and companies working in tight Permian gas who've been gaining some success in improving producibility there and gas flow. So we'd like to go back and most certainly have a look at what they've done and how they've achieved it and what we would need to do to adjust the programs that we've been thinking. And that's certainly going to take some time to do. So that for 927 is a goal that we would have at 6 months, a really clear line of sight on the type of program that we will be doing and what that'll look like and costs, etc., so that we can start executing that within the following 6 months to 6 to 12 months after that. ATP 2051 is, again, there's been quite a lot of planning and there have been thoughts around how I might drill a horizontal well. But again, a lot of companies have been doing horizontal drilling in the coals up in the north, in the Bowen Basin. And I know there are significant learnings over the last 3 or 4 years, which has made a few people change their thinking on how they might want to do the same type of programs within the Walloons. So that's another thing that we'll be addressing immediately. In the case of 2051, I'd like within 6 months that we hit a milestone operationally, that we've nailed what the program, those first 2 wells are going to be in terms of program. We've nailed the service contracts, all that's contracted. In a ideal world, you might say then that we're actually drilling, because the availability of drilling contractors and service companies. If that's not the case, it's certainly not long after the 6 month period we would be executing those programs and then going into doing longer term testing at that point. So in terms of the near time, that term, say 12 to 18 months, we would be looking in that block. It's certainly having drilled 2 wells and tested them and understanding, how they respond, William Coles, respond to horizontal drilling and what may be necessary for the remaining program to wells to improve or continue those results. I hope that answers that question.
Thanks, David. It sure does. And look, that's all the time we have today. Thank you all for joining me. And I'd also like to thank Scott and David for presenting and taking the time to answer some questions. As I mentioned before, a recording of the webinar will be on Pure Hydrogen's website and social media platforms later today. If you have any additional questions about the distribution of shares, I would encourage you to email investor@purehydrogen.com.au. Scott, before I let you go, did you have any final comments to leave with us today?
Look, firstly, thanks, Alex, for hosting today. We're quite excited about the potential of Eastern Gas. We think these assets, with the right board and management, and also with the right funding, can do very well. And we think certainly the path for commercialisation for Venus is very clear. The path for Windora is probably a bit longer, but certainly the upside's still very significant. So we're quite excited by this spin-out, and we think it's a good way to go forward for shareholders. So thanks very much for joining today.